Welcome to Bloomberg ETF IQ. I'm Scarlett Fu. Katie Greifeld is off for the day. Let's get to the biggest stories right now in the nearly $22 trillion global ETF industry. The global bond sell-off leaving the 30-year U.S. Treasury yield now at its highest since before the financial crisis. Now, in a few minutes, we're going to discuss fixed income and investment-grade credit with Matt Brill of Invesco. And after 6 weeks, the memory ETF DRAM is at almost $10 billion in assets. And by some measures, it's indicated to be one of the fastest growing ETFs in history. We'll get to more of that shortly. But as always, Eric Balchunas from Bloomberg Intelligence gets us started, and he kicks us off with a look at flows.
Thank you, Scarlett. Yeah, so the flows are, again, relatively bullish. A lot of money going into ETFs. This is a big number for the Qs. So that's a lot, and the Qs is used by traders. So that's about as good a sign as you can get. Tells you the traders are really liking NASDAQ 100, which is heavy tech and Mag 7. That's a big number. VU always on the list, but again, this tells you the retail crowd is vanguarding themselves every week as usual with more money into that. This is interesting. DRAM, as Scarlett just mentioned, this is a 1-month-old ETF, 6 weeks maybe. It just came out and it's already 10 billion, faster growing than IBIT, which is the BlackRock Bitcoin ETF that we talked about for like 18 months here. So DRAM, just unbelievable. Palladium, if this is right, and it might be a tax flow, but I don't think so. Big chunk of money into Palladium. Let's look at the outflows last week, and you're going to see SPY at the top. So a little bit money coming out of SPY and DIA. That offsets a little of that Q's excitement. There's some money coming out of Fidelity Fund, and small caps are interesting. We'll discuss that a little later on the show, that small caps just cannot get love no matter what they do. Whether they outperform, underperform, it's just very difficult. And a little money out of the industrials area as well. So I want to talk about an ETF, though, that is normally on the leaderboard, especially outflows. Soxel. A lot of people are using this thing. I know because it's one of the most traded ETFs. It's the 3X Semiconductors ETF. And it is up a ton this year. This is the performance of this ETF. You can see it just shot up, right? But then here's the flows. It's basically seen about $14 billion come out of it despite that performance. What's going on? Between the 3X semiconductor long and short, what happens is these traders, if it goes up, they take profits. So Soxel, in a way, all this is profit taking of this going up. So it's created a lot of cash, a lot of wealth here. That's what you should do, honestly. On the flip side, the 3X inverse has seen inflows as people try to buy the other side and sort of play it coming back. But for the most part, semis has been up, Scarlett. And so you see a lot of people taking profits. Hence it on the outflow leaderboard, almost every other week.
Oh, that's interesting with that dynamic with the flows. But as you always say, these are not buy and hold instruments, these triple leverage, double leverage ETFs. All right, Eric, joining our conversation right now is Matt Brill. Matt is head of North America investment grade credit at Invesco. And of course, you talk about chips and AI. And of course, you have to talk about credit these days. Soxel is a super leveraged bet on chip makers and their role in driving the AI boom. The capex that is required to build these data centers using those chips is really remaking your world, investment grade credit, with certainly a lot of supply already happening and due to happen in the next couple of months and years.
Yeah, there's been deal after deal announced and rumored. So there's a lot of deals that are being rumored just now, being backed by chips, by some of these semiconductors that are making these with large hyperscalers as their tenants. So there's a lot of money that's continuing to pour into here. It's, I think, fueling the equity market in many ways. But at the end of the day, if the fixed income market is not feeling comfortable with these transactions, it's going to be hard for these stocks to continue to grow. And they need our market. And from our standpoint, we're getting really attractive levels that we've never really been able to get within the tech space before. And there's a lot of nuances to these deals. And a lot of them are not in the index, which gives us a chance to have some different alpha that we can provide to clients.
When it comes to AI, do you have to have a take on whether this is like the next big thing, like people are saying, like the new internet, like something that big? Or does it matter as a bond manager? Or are there other ways to judge it without having to sort of play out how big it will get?
Yeah, so because we don't get the upside, we generally just think about what are the worst things that can happen. And so every deal that we're looking at, we're trying to structure and make sure that we're protected on the downside. And that can be things like amortization on these chips as quickly as possible, having very low loan to values on these type of transactions. So at the end of the day, if AI doesn't really turn out to change the world as much as we thought, at least we know that we have the cash flow from these particular credits. But it's almost like real estate deals where at the end of the day, if we know that there's a solid asset underneath underneath it. Even if it's really not used as much in the future, it can still be a good investment for us. And that's really the difference between having the equity upside where you can make 10 times and us just getting our coupon and hopefully our principal back.
Do you see any signs of buyer fatigue? I mean, maybe not at the investment grade level, but certainly when you go down in quality, there might be some more hesitance to buy exactly what's being sold right now?
There's buyer fatigue and I would say just concern that this is going to continue to happen. And so we're finding really attractive deals, but we're wondering, is this the last one we're going to see? Should we use our last chips on this one? Because this is I hate to use the phrase chips, but this is our last bet on this, because this is something that's so attractive that we haven't been able to see before. And then next week, there'll be something that's even more attractive. So we just need to make sure that we're really kind of spacing out our bets. We're using multiple different hyperscalers. And so I think we're saturated in it, but there's still some room because this is such a great opportunity.
Okay, let's talk about the Fed and the new chairman. So I'd like to not overthink things. Trump picks this guy. He's going to have to lower rates. It's that simple, isn't it? Like, are people coming in, oh, no, they're going to raise? I don't know. Like, isn't that overthinking it? Aren't rates just going to go down over the next year, and how low will they go?
So there's two parts of it. One is that used to really seem simple. Now it's not as simple, but we'll come back to that. But two is that you always have to think about the bond as a full curve. So even if they do cut on the front end, if nobody really believes that it's warranted, the back end is going to go up, and yields are going to go higher 10 years and further out the curve, which is not what the government wants either. So he wants housing prices to be more affordable, which means getting mortgage rates down, which you need to have 10 and 30-year treasuries go lower for that. But yes, overall, I would have said a month or two ago this was an automatic thing, and all of a sudden we've priced out all the cuts, and now there's even discussions on us having hikes on the table. And at the end of the day, it's about inflation. So what we're seeing inflation-wise is twofold. One is obviously the war and things that are going on with that in terms of commodities. We think that will pass. We think we'll get a resolution there. Two is the near-term effect of AI, all this CapEx spending we're just talking about. That is driving prices higher over the near term. The longer term, and what Warsh is going to argue, is that the productivity increases from AI are going to outdo any of the near-term price increases and will be so much more efficient and productive than we've ever been, and therefore he can cut rates. It's just really hard for him to say it right now.
Right. I mean, it's hard to do that when oil prices stay at the levels that they're at. What we're seeing right now is elevated rates, not just in the U.S., but around the globe, a global sell-off, and it really took root at the end of last week. Some people are saying this is the return of the bond vigilantes, especially in the UK, where there's a political crisis, and Japan, where we saw wholesale inflation really surge. Is there a bond vigilante return, and is it now seeping into the U.S. as well?
I think there is a little bit of that happening globally, certainly around fiscal responsibility is topics that are coming up. You've had Japan that's been really have no inflation forever. All of a sudden they have some inflation coming, and they need to start increasing yields over there faster. But overall, I think it's more inflation focused for now, and budget deficits come up from time to time. If the Treasurer will move things to being more front-end loaded in terms of issuance. So I think they have ways around this, but we do need to see some fiscal responsibility, and that it's just really not on everybody's minds right now. But at some point, you're going to get some more balance there. But overall, once you start to get yields at these attractive levels, 5% on a 30-year Treasury, there's a lot of corporations that are doing 30-year bonds at 6%, investment-grade names. These look attractive to investors. So I think there is a bit of a ceiling there because there is so much demand for yield from pension plans, insurance companies, annuities, et cetera.
Okay, let's talk about bond managers, which you are one. Okay, you run GTO, you're benchmarked to the AG. Now, you brought this up because you heard me talking about it. Bond managers, are they that much smarter than stock pickers? Because you guys are beating your benchmark by 58% of you. Only 26% of stock pickers are beating their benchmark. This is over 5 years. Are you just smarter, or is it possible that the benchmark isn't good? I compare the AG to playing against the New York Jets every week. It's weighted by debt, whereas the S&P is full of momentum. Did you guys just pick the right benchmark?
So I would love to say we're smarter, and over 10 years, those numbers are even better for fixed income. So longer term, it absolutely plays out. But the AG is a flawed index, absolutely. There is a lot of very high quality paper in that index, and you don't need as much quality of that as we don't think. So we can put other things in, like high quality corporates in there. We can put a little bit of high yield. We can put high quality AAA structured credit in there, and that's an easy way. But it's sort of like beating the Jets. I'm a Falcons fan. It's pretty easy to beat us over the last several years as well. But you're probably going to be able to do it. But the thing is the most important to know is that AGG, BND, the large passive ETFs still have over $100 billion in them each. And so it's not as if this is a benchmark we made up that nobody's using. This is a benchmark that people are using, have a lot of money in, and we think we and others have invented other products that are better. And that's why we're starting to see a lot of inflows into active ETFs as well.
Speaking of active ETFs, given how much supply is coming out from tech companies or companies in that industry, how do you ensure that you don't have too much tech? I'm guessing with all these new issues, it's a constant game.
Yeah, so it's all one big trade in a lot of ways right now, but you really do need to isolate your tech exposure, particularly things like the hyperscalers and all, and they're high quality, but at the end of the day, they are going to be correlated to this tech boom. But the areas that we're seeing the spillover to, and we think they can do well with or without an AI boom, is your classic industrials, middle America. This build out of AI is really, really positive for these industrials. And then two is the banks. The banks are a derivative of the economy, and they're making a lot of money on origination fees of all the debt and equity that are going on in IPOs, right, that are going to be hitting the market later this year. And that's a great way to play the market as well. So I like the banks, I like the industrials, but then kind of capping this tech space around 5% or so of your portfolio so that you're not so concentrated in the real focal center, focal point of the of this AI boom.
All right, good stuff, Matt. Always a pleasure, and thank you for coming into our New York studio today. Matt Brill of Invesco. Coming up on ETF IQ, JPMorgan deepening its push into crypto, the new filing that has the bank planning to launch its second tokenized fund. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Scarlett Fu. It's time for the ETF Brief, where we highlight stories and trends that caught my eye. Back in December, Invesco's QQQ was finally able to rally enough shareholder support to convert the massive unit investment trust into a full-fledged, open-ended ETF. Now, the QQQ fund has performed well since that time. And last week, Katie Greifeld spoke to Invesco's CEO, Andrew Schlossberg, about that vote.
It was a lot of work, but the shareholders in that fund, the millions of shareholders, voted to make that conversion. Fees are going to be lower for them. Of course, there is revenue for Invesco, but it's going to really enable that fund to continue to modernize and be the bellwether that it is.
Speaking of issuers, Vanguard is in position to dethrone BlackRock for the ETF crown. The Valley Forge-based firm is on track to overtake BlackRock in ETF assets under management in just over 3 years if its current pace of asset gains holds. Now, since 2020, Vanguard has narrowed BlackRock's AUM by an average $13.5 billion each quarter. Vanguard's competitive advantage lies in how its low-cost funds manage to attract disciplined flows even through volatile markets. And Eric likes to say that new ETFs take off because they're either shiny or cheap. Here's the shiniest of the new cohort of ETFs. It's DRAM, the Round Hill Memory ETF. As of last week, total assets are within spitting distance of $10 billion, reaching $9.983 billion on Thursday. Let's talk more about this with Bloomberg's cross-asset reporter, Isabel Lee. And Isabel, let me start with you about DRAM, because you look at DRAM and it's so interesting that this is a really simple concept, and yet it hadn't been created up until this point.
I think it's a perfect storm of timing, investor interest, and oh my gosh, I can't think of a third one. But it is a perfect storm. I was trying to think of three metrics. It beat IBIT. Can you believe it? Like, it hit 10 billion in like some 27 days. It's up some 90% since its launch, and retail investors are really piling in. Like, I went on Reddit to find one. It wasn't that hard because there was just so many conversations about it.
Let's talk about this table that we came up with. It hit $9.98 billion. I'm going to call that 10.
It's 10.
So it hit $10 billion in 43 days. That's insane. IBIT, which we went wild talking about for like 2 years, hit it in 50 days. Then you go down the list, most other ETFs took 100 days, 1,000 days. This is really something. What happens from here? Like, obviously, this is a thematic ETF. And unlike IBIT, which had 11 years of demand building up because the SEC wouldn't approve it, this is sort of like a, what would you call that? Like a flash in the pan kind of moment. Although the memory business is obviously growing. Our analysts see it's going to grow. But at some point, it's got to come down. I mean, how far could this go?
I think you were quoted in this story. You said that maybe it will eventually top off, but then AI isn't going away. And I think this is true. And for this ETF, it's really just a play on SK Hynix and Samsung Electronics. At least the person we interviewed, Ben Eames, said that that's why he wants it, because it's a concentrated bet. And these are Korean companies that you can't really access easily in the US. So that's what ETFs are for, right? They're an easy wrapper. You click on whatever brokerage you're on, and then you have it.
Yeah, it's a brilliant idea, and the timing is impeccable. I think
Perfect
that's what it
timing.
comes down to, right? I mean, now that it's there, everyone's like, oh, of course, it makes total sense, but the timing does it all. All right, I want to end things on JPMorgan Asset Management, which is planning to launch its second tokenized money market fund. The fund would issue digital tokens on the Ethereum blockchain, representing shares in its underlying portfolio of treasuries and repo agreements. These tokens can be held in digital wallets or used as collateral in crypto markets. So let me ask you, Vildana, I mean, this is not necessarily in the ETF world, but this is something that a lot of people are starting to talk about. How much demand is there for something like this?
Yeah, and we can say that tokenization is a little bit in the ETF world, because we reported some months ago that even BlackRock was looking to tokenize some of their ETFs. I think we can think about it from an institutional perspective. So some of these companies are looking at tokenization as something, one of the next big things, because it sort of helps when you have the tokenized funds. It's a lot quicker than the traditional way in terms of settlement and transfer and things like that. And so a lot of the institutions really are looking at it. We know that some of the biggest names have been doing this. We know BlackRock has a really big tokenized fund. This is JPMorgan's second money market tokenized fund, and potentially maybe we can see some of these big banks coming out with other additional products. I think from the retail perspective, that is a little bit more debatable. I think the average person probably is like, tokenization what? Maybe Eric disagrees with me, but yeah, from the institutional perspective, it's just quicker, faster, and it's tokenization is a hot topic.
Yeah, well, money market mutual funds took in like $700 billion last year. A lot of people like the stable NAV. You cannot have that in an ETF. This would have a stable NAV of $1. That's important, and it's only 16 basis points. So in a way, this particular token seems like ETFization, but I don't know if tokenization is really going to like disrupt ETFs. But for places ETFs can't go, like stable NAVs, I can see this taking off. And the low fee, this is way lower than most other big money market mutual funds out there. So maybe some retail interest.
Potentially. I think I'm thinking about what's happening in the crypto market in general right now. There seems to be a little bit less retail interest in certain crypto things, in tokens, in Bitcoin, in buying Bitcoin outright. The flows that we're seeing into Bitcoin ETFs, for instance, there's some data to suggest that it is coming from institutions of late, and that maybe retail has moved on to perpetual futures, maybe, or prediction markets, things like that. So I'm thinking about it from that perspective, but certainly maybe down the line.
All right, well, it's something that I think we're going to be talking about more and more with tokenization really taking root, especially among institutions. Bloomberg's Isabel Lee and Vildana Hajrek, they are both part of our cross-asset team. And a reminder that you can also tune in to Eric and Joel Weber on Trillions, their podcast that covers the industry. Are you going to change this to tens of trillions or hundreds of trillions at some point?
Yeah, what's the next one after Trillions?
Quadrillion.
Quadrillion?
Yeah, we're not there yet, though.
Yeah, no, maybe like 3 or 4 years.
All right, well,
yeah.
Joel will be, by the way, back with us at the end of the hour for our IQ test. Anyway, still ahead on ETF IQ, we look at the risks in a small cap ETF through the Bloomberg Intelligence traffic light system. This is ETF IQ on Bloomberg.
I'm Denise Tsekwa. Let's take a look at your midday movers. Wall Street's rebound attempt is failing. Stocks are falling. Oil is rising after doubts resurface about an imminent U.S.-Iran deal that would restore energy flows through the key Strait of Hormuz. The S&P 500 erasing gains and U.S. crude topping $106. Iran has given an updated proposal to end the war, but the White House believes it is not enough, Axios report. In corporate news, NextEra Energy agreeing to buy about $67 billion in stock for Dominion Energy, the biggest power deal ever. Dominion shares jumping as much as 12%. And lastly, Seagate Technology shares fell as much as 8%. After the management comments raised fears, it may not keep up with soaring demand for memory chips. Those are your midday movers. I'm Denise Tsekwa.
It is time now to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk level. So green light means low risk, yellow light means moderate risk, and red light means high risk. Eric has picked one out for us today. Eric, what do you have?
Today we're looking at the small cap space. I said we'd talk about it because there's interesting things going on in small caps. The one today is AVUV, AVUV. It's the Avantis US Small Cap Value. So small caps, believe it or not, are finally outperforming. This year they are up 11% versus 8% for the S&P. But small cap value is up 14%, and this one is up 15% AVUV. Believe it or not, this ETF is $26 billion. So there are a couple bright spots that are seeing flows. This one is one of the few small cap ETFs seeing flows. We give it a green light with only one mark for being active. Now, there's nothing.
Why is that a mark against it?
Because, I mean, at this point, we could debate this, but we just figured you sit down, you fire up your brokerage account, and you just assume everything's kind of like VU.
I see.
And if it deviates anything from like a very plain vanilla beta experience, we are going to tell you. That's why I don't know if risk is the right word. I just say it's a advanced information and potential nasty surprises. But the small cap space interesting to us because it's doing well, but there's just very few flows. This guy though is seeing inflows.
I mean, small cap on its own is already hard to get attention, and even when they do pick up a little bit of momentum, it dissipates so quickly. The minute that the S&P 500 or the Nasdaq come roaring back, everyone streams out of small caps, and I feel like small cap value is an even smaller subset of that.
I know there are some people in the quantitative side who are like, man, when small cap value finally works, look out, because it crushed during the 2000s. I mean, it crushed large caps, but the thing with small caps, we think there's actually like a real bigger issue here. Look, that's the percentage of ETF assets made up by small caps. It was 10% 10 years ago. Now it's 4%.
That is remarkable.
And a big thing is thematic ETFs, I think, are stealing some thunder. They include small caps and they're more fun. The other thing is private companies. They are not going IPOing when they're smaller. They're waiting till they're huge, like SpaceX, and coming right into large. So it's like this farm system of up and coming stocks you don't have any more superstars in there.
Right. They're all joining in at the pro level.
So I think you need 2 years of outperformance before people actually start rotating. I think they just look at this as like a head fake.
Yeah, no, we're not there yet.
But AVUV is for real, in my opinion.
If you look at the 2-year return for the S&P 500 versus the Russell, which isn't even Russell's value, right? You've got 19% annual return for the S&P, 16% for the Russell 2000.
Yeah, and a lot of these large companies like Mag 7, they've acquired 850 companies, and a lot of them are small. So all the good small caps are just getting sucked up into large, too.
Yeah, they just become big caps. All right. That is our traffic light system. We do have a breaking news headline here. The U.S. is planning new Russian oil waivers as the Iran war crunches supplies. So if you look at how oil prices are performing at the moment, WTI, which is the U.S. benchmark right now, is trading higher, 1.6%. Not really moving on this headline, but again, the U.S. planning a new Russian oil waiver as the Iran war crunches supplies. This is Bloomberg ETF IQ. I'm Scarlett Fu. It is time for today's drill down where we focus on one ETF. Eric, what do we have?
Scarlett, today we have ELFI, cute little name for this theme ETF, the Alps Electrification Infrastructure ETF. Okay, what does that mean? So all these AI companies and just society in general are going to need electricity, right? Just like they need high bandwidth memory. These are companies that they're going to lean on to provide that electricity. It's a pretty new ETF. It's about a year old, and it charges 50 basis points, about the median for a theme ETF. It's got 188 million. That's pretty good. It's successful in terms of themes. Let's look at the cross-section of holdings so you get an idea of like the kind of industries you're buying here. Obviously, utilities, electric utilities, electrical equipment. And then you got oil and gas, metals, tech hardware, renewable energy, and chemicals. You know, looks a little like the Halo trade. A lot of those like physical reality kind of stocks. Let's look at the performance here. Now, I brought the S&P, but I also threw Grid in there. Grid is a similar, it's kind of like a popular infrastructure, clean energy kind of ETF that First Trust has. So you can see that ELFI is crushing the S&P. That's probably why it has 188 million. Grid up similar. So I think this is good for flows, and these two are why they are growing, Scarlett. If it can beat Grid, even better, but tripling the S&P is obviously going to help your cause.
Definitely. All right, Eric, joining us now to talk more about this ETF, ELFI, is Paul Baiocchi. He is head of fund sales and strategy over at Alps. And as Eric was saying, ELFI was launched about a year ago. So this is something that you kind of planned for. What was the thinking at the time in the first quarter of 2025 when you were putting together the prospectus for this ETF?
So the guy who designed the index, Mark McLean's in utility finance over at Ladenburg Thalmann. He's been in the category for 20, 25 years, and he actually came up with the index methodology before the AI data center explosion and the ramp up in electricity demand coming from it. He put it together in advance of, or in response to, the renewable portfolio standards that a lot of states adopted when we got out of the Paris Accord. And so this forced spending on renewables, decommissioning of fossil fuel-oriented electricity generation meant that there was going to be a ramp up in infrastructure investment. And now you add AI data centers and reshoring, you start piling on all of these different drivers of electricity demand. And we felt it was additive to a portfolio context.
Let's talk about the weighting, equal weighting, right? This is an interesting thing. So thematic ETFs, if you equal weight them, you have more love for the small stocks, which can get acquired, right? But what would be the case for equal weighting? Because you do sell winners as they get going. What would you say to that?
Yeah, so if you ask the guy, Mark, who created the index, he would say that you're feeding your fishes at each quarterly rebalance and you're taking some off the table from some of your winners. And I think there is a natural mean reversion element to an equal weighted strategy. I don't think it fits with every segment of the marketplace. But to your point, in thematic products, often what you see is heavy concentration. You mentioned a competitor to ours in the category, which was launched much longer before we launched ELFI. And you've got names like NVIDIA in there. You've got some names in those strategies that don't have pure play exposure. And so when those companies grow disproportionately, they can overwhelm some of the exposures that you're trying to accomplish. There's a $5 billion minimum market cap for inclusion. There's a minimum notional daily dollar volume. So there are some screens that mean you don't go too far down the cap spectrum.
Gotcha. ELFI is an example of allocating towards real assets. And this is something that you've kind of built out, this portfolio. You have a bunch of other funds, including SDCI, which covers commodities, CCNR, natural resource equities, and you kind of see it as a thematic fund addressing real assets in a way that people can gain exposure to all of that, maybe in concert, maybe together, maybe a combination of those. Is there any overlap between these funds? I imagine there's got to be some.
Without a doubt, and ELFI is comprehensive in nature, meaning it's got energy infrastructure, so pipelines, moving natural gas. You can juice up your exposure there with, say, AMLP or NFR portfolios that are targeted in that segment of the market. Think about it as portfolio components that you're mixing and matching depending on your objectives. If it's income, if you want to enhance your nuclear exposure, there is some nuclear exposure in ELFI, but if you want to target that, something like SMRF would allow you to do so. The commodities piece is really the only thing that you don't have exposure to in ELFI because it doesn't own futures contracts in SDCI or even its sister fund ESB, which is focused on battery metals, will give you that. So it's all about taking your portfolio and in many ways diversifying into categories that you don't have a lot of exposure to. You know, tech companies, hyperscalers, the ones driving rising electricity demand, you already have a ton of exposure to them in the S&P 500, in VU or otherwise.
Absolutely. In our thematic capture score, we would look for active share. You want high active share. You want to not recognize the stocks because you already own the big ones, right? I agree.
You've got your exposure to VU and everything else. So.
Yeah, so I think differentiation is huge for themes. Let's talk about the dogs. That's how I know you guys. S-Dog, I-Dog, R-Dog. You have a whole suite of these dog ETFs. Dow's, what's the name of it again? It's the Dividend Dogs ETF, right? So these are, people know that phrase, but these are sector oriented. So can you go over how these are doing and what they do for investors?
Yeah, so S-Dog, I-Dog, E-Dog, R-Dog, you mentioned all the dogs. It's a kennel we have over at SS&C Alps Advisors. But basically it takes that old dogs of the Dow approach, which is one of the oldest investing mantras around. And you take the 5 highest yielding stocks in the Dow Industrials at the beginning of the year, and then you change it at year end, and that doesn't work for a RIC compliant strategy, of course, and so you expand the universe in the case of S-Dog to the S&P 500, pick the 5 highest yielding stocks in each of the GIC sectors in the S&P 500, and you equally weight them. So you have balanced sector exposure, but it really is a value yield oriented way to approach value and yield investing, do the same thing in iDog. And I would look at iDog maybe as the example recently of an allocation, as we were talking about before we went on the air, of people reallocating developed ex-US, and iDog has had really strong relative performance to that EFA universe.
This idea of getting yield from stocks, right? It is under fire because you got the JPs of the world, then you've got auto callables. I mean, they're coming at you, and we've seen the market share of stock dividend ETFs come down. How do you push back against all these, we'll call the derivative income ETFs?
So our argument is that there's a lot of these old school, if you will, building blocks that can be really compatible with a long-term investment plan, and you don't necessarily need to get that creative with all of your exposures. Of course, auto callables, buy rights, defined outcome strategies have their time and place for certain investors, but you look at just how most investment portfolios are constructed. You've got the piece that's in fixed income, and people, as you know, have been allocating more and more to active fixed income in the ETF wrapper, perhaps more than ever before. But within the equity sleeve, there's a lot of different approaches to going and achieve ambitious, in some cases, yield goals. And dividend yielding stocks are very much a part of the framework and the pattern in which most people allocate.
All right, Paul, thank you so much for joining us today. Paul Baiocchi, head of fund strategy at Alps. And you can read all about this particular drill down, plus the latest in the ETF industry when you subscribe to Katie's weekly ETF IQ newsletter. You can subscribe at Bloomberg.com/ETF IQ newsletter. Coming up on ETF IQ, our television show, Vanguard launching 2 new international funds. Kathy Kellert, who is head of index equity product, will be joining us to discuss. This is ETF IQ on Bloomberg.
We're halfway through the trading session in New York. I'm Denita Tekova. Let's take a look at your midday movers. First up, stocks are losing steam on Wall Street with the S&P 500 erasing gains and the Nasdaq 100 down about 1%. On the other hand, oil is rising. Doubts return about a near U.S.-Iran deal that would restore energy flows through the key Strait of Hormuz. U.S. crude topping $107. Iran has given an updated proposal to end the war, but the White House believes it is not enough for a deal. Also, in bonds, Treasury moves are subdued compared with the rout we saw on Friday, but global yields are near multi-year highs. The 30-year Treasury yield is hovering near the highest level since 2007. And Bitcoin is weakening to its lowest level in more than 2 weeks, falling to about 76,000 as traders cut position. Meanwhile, Strategy brought about $2 billion more in Bitcoin, lifting Michael Saylor's holding to about 4% of supply. Those are your midday movers. I'm Denita Tekova.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get you to the ETF life cycle, where we walk you through the 3 main stages of ETFs, from initial filings to final farewells. Step 1 is the filing. The SEC reviewing paperwork for a string of single stock leveraged ETFs from Defiance. The issuer proposed 2 times long funds on Horizon, Quantum, Jabil, MaxLinear, Everpure, ST Microelectronics, and Symbiotics. Step 2 is the launch. The ETF world wastes no time because AI chipmaker Cerebras, I should say, listed under the ticker CBRS last Thursday. And less than 24 hours later, the leverage shares 2 times long CBRS daily ETF began trading. This is likely a sign of other things to come, with other prominent IPOs like SpaceX coming out later this year. And for some, the final stage is farewell. Say goodbye to a trio of ESG funds that State Street launched just over 4 years ago. E6 was a passive spider fund tracking small caps that met certain sustainability criteria. MBNE was an actively managed State Street Nuveen Muni Bond fund prioritizing ESG traits. And NZUS was a spider MSCI USA climate Paris aligned ETF that provided exposure to large and mid caps, but no more for any of them. Vanguard also had 2 new launches recently, tickers VDG and VDV. Both are developed market ex-US. One is growth and one is value. They're both index ETFs. Kathy Kellert is head of index equity product at Vanguard, and she joins us now to discuss. So these are passive funds, but they don't have the US involved at all. Developed markets ex-US. What prompted this creation of these 2 funds?
First, thanks for having me. Yeah, we saw an opportunity with these funds, VDV and VDG. So as you said, developed growth and value, to bring broad-based index exposure at that low cost you'd expect from Vanguard, 8 basis points.
So let's talk about this. I mean, my thesis is you guys were sitting around, well, you don't sit around much, but you were working, and someone's like, hey, look at the ACWI, that's the all-country world. If you look, the US makes up 65% of the world in terms of market cap. Number 2 is Japan at 5%.
That's a big drop
That
off.
is insane. And you probably thought our clients are way over leveraged US. Let's give them something that just gives like no US at all. Am I right? Like, is that what the idea was?
These products, we weren't trying to time any particular market. We really view these as long-term building blocks in a portfolio. But we've long believed in the benefits of international diversification. Why have all of your focus on a single market for having winners and losers when you can have that diversification benefit and spread your risk?
What kind of demand have you seen for products that exclude the United States and focus on international markets?
Yeah, we have seen investors looking to build out in different ways their international equity portfolios. And so we already offer these broad-based index funds, think VXUS, VEA, VWO. But we see more investors now looking for more targeted exposures, and these funds give them more flexibility there.
And to your point, Eric, as we just showed in that chart, the U.S. makes up the lion's share of equity.
It looks like Pac-Man. It's like eating everything.
Yes, exactly.
Yeah.
65% compared to everything else. I mean, nothing else tops 5%. And Taiwan is big because of TSMC, essentially.
So, look, obviously, I'm pretty familiar with your founder, Jack Bogle, having written a book on it, shameless plug called The Bogle Effect. And he trashes a lot of things, including international. And you're not alone. He trashed ETFs. He's trashed smart beta. How would you talk to somebody who's like a Boglehead, who comes and says, hey, look, Jack told me I don't need international. I just need US. So why would I ever buy these?
Yeah, I think we continue to be focused on the long-term investment principles that Bogle espoused. And we do see if you have US exposure in your portfolio, yeah, you're going to have some clear leaders and winners in the market today, but over time we know leadership shifts in markets. And so as you see the AI megatrend play out, we see leadership expanding beyond the US and there being real opportunity. You think in international, you think a lot of financials, a lot of companies that can benefit from AI productivity gains. So spread out the risk and return potential.
Bogleheads are also pro-passive, right? Anti-active. It's all about letting the index do the work.
They're anti almost everything except like cheap beta.
Okay, cheap beta is the Boglehead mantra.
Yeah.
So most of Vanguard's recent high-profile launches have all been active. I mean, there's been a lot of active ETFs. So I'm curious, why go back to passive now?
Yeah, so as you know, we have a very robust, mature index equity lineup. But for us, it's not about index versus active. We see these strategies meeting different investor needs. I'm focused on the index equity space, and there's still demand for low-cost beta. But we can see that as a complement or just a different strategy, and we want to offer both with active and index to our investors.
So you and BlackRock are like King Kong and Godzilla, right? Everybody else is just feeding off the crumbs. So these two are going at it. You have like 4.5 trillion each in US ETF assets. You're less than 100 billion behind. How ambitious is Vanguard to finally pass BlackRock? VU already passed SPY. These probably will help the cause. How big is market share for you guys?
Yeah, so for us, it's less about the outcomes, less about taking over that leadership position, and it does really anchor back to serving our investors for the long term. So we love to see the cash flow, but that to us is really just a testament of doing what's right for investors.
I mean, is this something you guys talk about in your Monday meetings, keeping track of who's where?
We all have our regular reports, but truly we are focused on, and that's what's great about our company structure, is the way we are structured. We are aligned with our investors. So our scoreboards are really more about how are we returning benefits, how are we lowering fees in a very sustainable way over time.
You know what's amazing? Even though BlackRock and Vanguard have the same assets, BlackRock is 4x the revenue. Because your asset weighted average fee is 4 bips. These actually bring it up a little bit. These are like expensive for you guys. But how hard is it to get a new ETF through the approval process at Vanguard? Because you don't launch a lot. And then how do you pick that fee of 8?
Yeah, so as I'm sure you can imagine, we have a very rigorous, disciplined approach to product development. We have our product design principles, and every product we have to vet long-term investment merit, enduring client demand, and a product where Vanguard can have impact and be differentiated in the market as well. When we say 8 basis points, yeah, we wanted to bring our highly efficient indexing to the market, and I mean, that is a very competitive fee for this product.
What kind of feedback have you gotten from advisors on these 2 new products?
Yeah, positive feedback. In fact, there was a lot of advisors asking for a lower cost alternative in this space. All existing products were 20, 30 basis points. A lot of active strategies in this sector.
Sometimes other people Vanguard a category, but sometimes the OG does it.
Yeah, they come in, they're like, you know what? It's time for us to put our
I know,
stamp
they
on it.
ruin it for everybody.
But they have the last laugh in the end. Kathy, thank you so much. Kathy Kellert of Vanguard. She is head of index equity product at the firm. Coming up, it is time for an IQ test where Joel Weber puts our ETF knowledge to the test. And here is a sneak peek at one of the questions. Which ticker belongs to the largest single stock ETF by assets? Is it MUU, Micron, NVDL, NVIDIA, MSTY, Strategy, or TSLL, Tesla? The answer after the break. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Eric Balchunas. Katie Greifeld is off for the day. It is now time for an IQ test where Bloomberg's Joel Weber is going to see whether Eric and I really know our stuff when it comes to ETFs. And because Katie is not here, it's really head-to-head, Eric and me. So Joel co-hosts the Trillions podcast with Eric, so he has an unfair advantage. Eric does, and Joel does. But Joel is also the head of games here at Bloomberg, which is an unusual but also fairly new title. So Joel, put us to the test.
I'm excited to do that. I also want you to know I think about you when I do these questions.
I hope so. I hope
it's
so.
not all just
so it's
like
balanced out a little
pandering to
bit.
Eric. Yeah, exactly.
Okay.
All right.
I lost last week. So.
Let's see. We've teased this one already. Which is the largest single stock ETF by assets? Is it MUU, NVDL, MSTY, or TSLL? The companies that are associated with those tickers are alongside there. Eric is very confident. You can
I know.
He's like radiating it.
During the commercial break, he was already saying he knew the answer to this.
But not revealing it. So, Scarlett, what are you going to?
Oh, gosh. I'm going to go with NVIDIA since it's reporting earnings this week.
Okay, Eric?
That was number one, but Tesla took over.
Really?
D.
Right, it's D. Yes.
So this is as of
close.
yesterday, as of today?
Last Friday is down.
Last Friday, okay.
There we go. All right. So
I was kind of right.
So there's one.
Very
Partial credit.
Warm.
Congrats, Eric. You were right. Not always true. Let's see if you can keep your streak going. Question 2. What's the term for ETF strategies that seek treasury bill-like returns using option structures such as box spreads? His eyebrows went up, as did Scarlett's. A, portable alpha. B, structured carry. C, synthetic cash. Or D, overlay yield. He's wincing.
Yeah.
Scarlett's searching. Shot in the dark.
I'm going to go with C, synthetic cash.
Okay.
I'm going to agree. Who on my team told you to pick this one? I've never even heard of this.
Just go into your Bloomberg intelligence
Good question.
research
I'm going to go with C.
and
I'm going to
look.
agree with Scarlett.
You guys are both right.
Okay, good. Nice.
Synthetic cash. You go deep into the ETF weeds sometimes to find out what these are going to be. Okay, third question, final one. The ETF ticker ISF tracks which flagship equity index? Is it A, FTSE 100, B, FTSE 250, C, Russell 1000, or D, the FTSE China A50?
I'm going to go with D.
Straight out of the gate.
Wow. Yeah, I'm going to. It's obviously a FTSE because there's 3 of them. Head of games. Head of games, that's a tell.
Pretty confident.
I'm going to go with FTSE 250B.
Okay, both wrong. A.
Oh,
FTSE
really?
100. Thanks for playing. I
It wasn't
love it
Russell.
when you get a little blemish on Eric's resume. All right, well, if you like playing games, go to QuizGo on the terminal to play our news quiz, and also go to bloomberg.com/pointed, where we've got another news quiz where you can play with some leverages, go 3x, test your confidence, be humbled.
So what was the score again for today?
That was 1 and 2, 2 and 1.
All right.
So
okay,
yeah,
decent
well,
outcome.
you know, as long as he doesn't win, that's a win for us.
Exactly. Well said. Joel Weber, thank you so much. And of course, be sure to check out Joel and Eric's podcast called Trillions. It's available wherever you find your podcasts. And a quick programming note, because of Memorial Day, we will be back on Thursday, May 28th. So tune in to ETF IQ then. That does it for this edition of Bloomberg ETF IQ. I'm Scarlett Fu, along with Eric Balchunas, and this is Bloomberg.